Silver collapsed to $76, Wall Street's dirtiest trick. And if you don't know what just happened, you're already behind. This was not a crash. This was not panic. This was not the market deciding silver was worth less. This was a decision, made in a room you were never supposed to know existed. $13 wiped out in hours. Millions of retail investors sold, walked away, called it a loss. But the institutions, they were buying every single share. And the question you need to ask yourself right now is not why silver fell. The real question is, who needed you to believe it did? Because what happens in the next 72 hours could either be the greatest opportunity of this decade or the moment you looked away right before everything changed. Welcome to the hidden currency, the place where the real story lives. Not the headline, not the ticker. The truth underneath both. Now, before we go any further, if you have been watching this channel for a while, you already know what we do here. But if you are new, think of that one wise person in your life. The one above 50. The one who never panicked. The one who always said, "Son, read between the lines." That is this channel. And if that speaks to you, hit that subscribe button. Not for us. For the version of yourself that refuses to be kept in the dark. And one more thing before we begin. Drop a comment below right now. Just one word. Your city, your country, wherever you're watching from. Because this story is not just about silver. It is about every single one of you. Now let us talk about what Wall Street did not want you to see. On a quiet Friday afternoon, something happened in the silver market that stopped serious investors dead in their tracks. Silver closed the week at $76 per ounce. Just 4 days earlier on Tuesday, silver had touched $89. That single number had the entire financial world paying attention. It was a level that had not been seen in years. Traders were excited, analysts were watching. And for a brief moment, it looked like silver was finally about to do something historic. Then it all fell apart. In less than 96 hours, silver lost $13 per ounce. That is not a small move. That is not normal market behavior. A 9% loss on Friday alone made it one of the most violent single-day drops silver had experienced in the entire month. The weekly candle that formed on the chart was deeply bearish. Red, wide, brutal. And it left millions of retail investors staring at their screens asking one simple question. What just happened? Most people watching the market that Friday assumed it was panic. They assumed it was fear. They assumed that the broader economic environment had shifted overnight and that silver had simply reacted the way markets react when sentiment turns negative, but that explanation does not hold up under pressure. When serious analysts began pulling apart the data behind the move, something unusual emerged. The selling did not happen gradually. It did not build through the morning as traders processed news. It came in concentrated waves, sharp, sudden, and perfectly timed to hit the market when liquidity was at its thinnest. When fewer buyers are present, even moderate selling pressure creates outsized price drops. Whoever executed this move understood that principle very well. They used it deliberately. To understand what actually happened, one has to go back to Tuesday and the significance of $89. For months, silver had been building a structure. Starting from its February low of $62, it had climbed steadily higher, higher lows, higher highs, a rising trend that every technical analyst in the world could see on a chart. By the time silver touched $89 on Tuesday, it had gained nearly 44% from that February floor. Oh, the momentum was undeniable, the structure was strong, and the next major level sitting directly above was $90. That number matters more than most people realize. In the world of commodities and futures trading, round numbers are not just psychological markers. They are structural triggers. Positions are built around them. Stop-loss orders are placed near them. Margin thresholds are calculated with reference to them. When silver was sitting at $89, it was $1 away from a level that would have forced a chain reaction inside the paper silver market. A chain reaction that certain institutions could not afford to let happen. Here is where the story becomes important for every businessman and entrepreneur watching this breakdown. Markets do not always move because of sentiment. They do not always move because of supply and demand in the physical world. Sometimes markets move because a specific group of players has a specific financial reason to make them move. And when that group is large enough, connected enough, and experienced enough, they have the tools to engineer exactly the outcome they need. The retail investor sees a crashing price and calls it a bear market. The institutional player sees a controlled operation and calls it an opportunity. That gap in understanding is exactly where wealth is transferred. Quietly, efficiently, week after week. And this past Friday was a masterclass in how that transfer happens. What makes this particular collapse different from ordinary market corrections is not the size of the drop. It is the precision of where the drop stopped. Silver did not fall randomly to $76. It did not overshoot. It did not break through the major support structures that had been building for 3 months. It landed exactly on the rising trend line that connects every major silver low since February. The same line that passes through $62 in February, through the April lows, through the May consolidation floor, ran directly through $76 on Friday's close. That level of precision does not come from panic. Panic is messy. Panic overshoots. Panic breaks structure. This did none of those things. What happened to silver this week was not a market falling apart. It was a market being directed. And the institution holding the steering wheel had a very clear destination in mind. In the next part, the exact mechanism they used will be laid out step by step. The playbook is older than most people in this market, and once it is seen clearly, it cannot be unseen. Imagine a room, no windows, no cameras, no journalists, no retail traders watching ticker symbols on their phones, just a table, a few men in expensive suits, and a decision that would move billions of dollars before sunrise. This is not a movie scene. This is not a conspiracy theory borrowed from the internet. This is the documented, studied, and legally challenged reality of how the paper silver market has operated for over 4 decades. And understanding what happens in that room is the difference between being the person who loses money on a Friday and being the person who quietly profits from someone else losing it. Since the early 1980s, the largest bullion banks in the world have maintained something called a short position on COMEX silver futures. A short position, in simple terms, means they have made a financial bet that silver will go down, not a small bet. An enormous, structural, institutionalized bet that has been rolled over, renewed, and expanded across decades. Their entire business model depends on silver staying below certain price levels. Those levels are not random. They are calculated, they are defended. And when silver gets close to crossing them, those institutions do not sit quietly and accept the loss. They act. They have always acted. And they have the resources, the connections, and the market access to make their action count. The 3 magic numbers are $80, $90, and $100. Each one of those levels represents a structural danger zone for the paper silver suppression system. Cross $80 and momentum traders flood in. Cross $90 and automatic margin calls begin firing across institutional short books. Cross $100 and the psychological dam breaks completely. What follows after $100 is not a rally, it is a detonation. The previous all-time high of $121 comes into direct view. A 27% move in days, billions in forced losses for the banks holding those shorts. A mathematical catastrophe for a system that has operated in the shadows for 40 years. On Tuesday of this week, silver touched $89. They were $1 away from the trigger, so they executed the trick. Step 1 was timing. They did not flood the market with sell orders during peak trading hours when liquidity is deep and buyers absorb pressure easily. They waited. They chose the windows where participation was thinnest, where a smaller number of sell orders creates a disproportionately large price impact. In those moments, the market becomes easy to steer. Step 2 was margin. Working through exchange-level mechanisms, collateral requirements were raised. When margin requirements go up, smaller traders do not have a choice. They must sell positions to meet the new demands or face automatic liquidation. This forced selling adds real downward pressure to a price move that was already being engineered from the top. Step 3 was the most elegant part of the entire operation. They targeted the stop-loss orders. Every trader in the market places a stop-loss order below a level they consider critical support. These are automatic sell orders that fire the moment price crosses a specific point. The institutions knew exactly where those orders were clustered. They pushed price down far enough to trigger the first layer. That triggered selling. That selling pushed price down further. That triggered the next layer and the next. Each wave of stop-loss orders became the fuel for the next leg down. What looked like a panicking market was actually a perfectly sequenced mechanical demolition. None of this is new. In 1980, the Hunt brothers had pushed silver to $50 per ounce through physical accumulation. The exchange responded by changing the rules mid-game, restricting new purchases and forcing liquidations. Silver collapsed. The Hunt brothers were financially destroyed. The banks were saved. In 2011, silver approached $50 again. Over the course of 9 days, the exchange raised margin requirements 5 separate times. Silver fell from $49 to $34 within weeks. Billions in retail wealth evaporated. Institutional shorts survived. In January 2026, the same mechanism was deployed again. Silver fell 33% in a controlled sequence from $100 down to $74 after another coordinated margin cycle hit the market. 3 events, 3 decades, one identical playbook. And here's the fact that every serious businessman needs to write down and remember. Every single one of those prior events was followed by silver eventually exceeding the level it had been crashed away from. The mechanism does not kill the move. It delays it. It shakes out the weak hands. It transfers the position from retail investors back to the institutions at a lower price. And then the next leg begins. The delay is the trick. The trick has never once stopped what was coming. There is an old saying among the most experienced traders on Wall Street: the market is never lost. It is only misread. Most people who watched silver fall from $89 to $76 this week read it as destruction. They read it as a breakdown. They read it as a signal that the thesis was wrong, the momentum was fake, and the rally was over. They sold. They walked away. They told themselves they would come back when things looked safer. But there was another group watching the exact same chart. They were not scared. They were not confused. They were not selling. They were counting. To understand what they saw, one has to understand how serious money actually reads a market. It does not read headlines. It does not read sentiment surveys or social media commentary. It reads structure. And structure in a financial market is built from one thing above everything else: price memory. Every time silver found a low and bounced higher over the past 3 months, that low became a data point. February's bottom at $62 was the first point. The bounce off the April lows was the second. The May consolidation floor was the third. Connect those 3 points on a chart and a line appears. A rising line. A line that tilts upward at a consistent angle, showing that each time silver pulled back, it pulled back to a higher level than the time before. That line is called a rising trend line support. And on Friday, when silver closed the week at $76, it closed exactly on that line. Not $1 above it, not $1 below it. Exactly on it. Now here is where most retail investors make the critical mistake. They look at that close and they see a near miss. They think silver got lucky. They think it bounced off support by accident. They thank the chart and move on without understanding the deeper implication of what just occurred. But experienced institutional analysts look at that same close and they see something completely different. They see a signature. When a market drops $13 in 4 days and lands with surgical precision on a 3-month rising trend line, that is not luck. Random selling does not have that kind of accuracy. Panic does not stop exactly where structure demands it to stop. Fear does not measure its own movements against technical levels drawn from months of price history. Only one type of market participant operates with that level of precision: the participant who already knows where they want to buy. This is the part of the story that separates the businessman from the gambler. When institutions execute a controlled price drop, they need a destination. They cannot simply crash a market and hope it stops somewhere convenient. They need to bring price down to a specific level where they can accumulate positions quietly without driving price back up before they are finished buying. They need a level where retail investors are already conditioned to expect more downside, where the news flow is negative, where the sentiment is broken. The rising trend line at $76 was that level. It was low enough to frighten retail sellers into exiting. It was technically significant enough to attract a new wave of buyers once accumulation was complete. And it was structurally positioned to give the next leg of the rally a clean foundation to launch from. They did not crash silver to $76 by accident. They crashed it to $76 because $76 was exactly where they needed it to be. 3 levels now define everything that happens next in this silver story. The first level is $73. That is the invalidation zone. A weekly close below $73 would mean the rising trend line has broken. It would mean the structure built since February is compromised. It would force a complete reassessment of the entire setup. The second level is $82. That is the re-engagement zone. A clean reclaim of $82 with strong volume would signal that the accumulation phase is complete and that institutional buying has finished loading at the lower prices. The third level is $89 to $90. That remains the trigger. The level that started this entire chain of events, the level the banks crashed silver away from, and the level that silver will have to reclaim and hold before the next chapter of this story begins. The question is no longer why silver collapsed to $76. That question has been answered. The only question that matters now is what happens at this line in the days ahead. Because whatever comes next will determine whether this week's crash was the end of a rally or the setup for something far larger than the move that came before it. There's a clock inside every financial market. Most people never see it. They watch prices. They read news. They follow the loudest voices in the room. But the clock keeps ticking beneath all of it, quietly, consistently. And every serious economist, every institutional strategist, every decision maker managing real capital knows one fundamental truth about that clock. Silver never moves alone. What happened to silver this week did not happen in isolation. It happened inside a web of connected markets, each one sending a signal at the same time, each one telling a piece of a story that the financial media never assembled into a complete picture. Understanding those signals is not optional for the serious businessman. It is the difference between reacting to a market and understanding it before it moves. Start with the US dollar index. During the exact window when silver was being pushed from $89 down to $76, the dollar did something that deserves very careful attention. It did not surge. In a normal market sell-off driven by genuine fear, investors flee to the dollar. They buy it. They trust it. Its value rises sharply as money pours in from every corner of the globe looking for safety. That did not happen this week. The dollar moved, but its movement was measured and controlled. It did not behave like a currency receiving an emergency flood of frightened capital. It behaved like a currency being used as a short-term tool, pushed just enough to add pressure on commodities, pulled back before it could signal a genuine flight-to-safety event that would attract scrutiny from larger macro analysts. When the dollar does not confirm a silver sell-off with a genuine surge, the sell-off is not driven by fear of the economy. It is driven by something else entirely. Then there are the treasury yields. When real economic fear enters the market, money moves into government bonds. Investors buy treasuries. Bond prices rise. Yields fall. That is the historical pattern without exception during genuine risk-off events across every decade of modern financial history. This week, yields did not fall in a way that confirmed a broad market panic. The treasury market was calm. Institutional money was not flooding into government bonds as a safe haven. The signal that should accompany a genuine collapse in silver simply was not there. Two of the most reliable confirmation signals for a real market crisis both failed to confirm what was happening in silver. That is not a coincidence. That is a fingerprint. The gold-to-silver ratio completes the picture. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio expands sharply, meaning silver weakens relative to gold, it signals one of two things. Either the global economy is entering genuine distress, and investors are choosing gold over silver as a pure safe haven, or silver is being suppressed artificially while gold continues to reflect real monetary demand. This week, as silver dropped 9% on Friday alone, gold held its ground with remarkable stability. The ratio expanded sharply, and in every prior historical instance where the gold-to-silver ratio expanded through a sudden violent silver sell-off, while the dollar and yields failed to confirm broader panic. What followed was a compression of that ratio. Silver moved faster and harder than gold in the recovery phase. It closed the gap, and it often exceeded the level it had been taken from. The ratio right now is flashing the same signal it flashed before each of the major silver recoveries of the past 2 decades. But here is what separates this moment from a simple trading observation. While paper silver was being sold on COMEX futures, the physical silver market was telling an entirely different story. Premiums on physical silver coins and bars were rising, not falling. Retail demand at dealers was accelerating. Wholesale buyers were quietly placing larger orders. The divergence between what the paper market was pricing and what the physical market was demanding had widened to levels not seen since the last major manipulation cycle. That divergence always closes in one direction. Paper prices rise to meet physical reality. Physical reality does not fall to match paper prices. It never has across the entire documented history of commodity markets. For the businessman and the entrepreneur watching this breakdown, the cross-asset signals are delivering one unified message. Capital did not leave silver this week. It changed hands. It moved from retail accounts that panicked on Friday into institutional positions that had been prepared in advance. The dollar did not confirm it. The yields did not confirm it. The physical market refused to confirm it. Only the paper price moved. And the paper price is the one variable in this entire equation that the most powerful players in the market have demonstrated, repeatedly and historically, that they can control. What comes next inside that paper market, and how the physical reality eventually forces the paper price to adjust, is the final chapter of this story.